Hi, let me bring all of this to life with a couple of illustrative examples. Composite scenarios based on patterns we see repeatedly across our engagements. Not any one specific client, but representative of what actually happens. First, a SaaS startup. Before, MRR was tracked in a spreadsheet that got updated only right before board meetings, meaning for most of the month, nobody, including the founders, had a clear real-time view of it. Churn and cohort numbers didn't match between the pitch deck and the data room because they'd been pulled at different times using slightly different definitions. Financial due diligence flagged inconsistent ARR definitions. The investors team found that ARR meant something slightly different in the deck versus the model. As a result, Series A conversations stalled for 6 weeks while the company scrambled to reconcile the numbers. After, an automated MRR and ARR dashboard, refreshed weekly, gave the founders and the board a consistent, real-time view. Cohort retention was reconciled to accounting revenue every single month, so there was never a gap between the story and the numbers. One consistent ARR definition was used across the deck, the model, and the data room, and the term sheet was signed within the standard 10 to 12 week window without the delays we so often see. Software and SaaS as a sector commands one of the highest multiples we track, 6 to 10 times revenue. But that premium is only available to companies where MRR and ARR reporting is genuinely airtight. Second example, an MSME manufacturer. Before, receivables aging was untracked beyond 90 days, meaning the company had no clear visibility into which customers were taking far longer than agreed to pay and how much of that was quietly accumulating as risk. Inventory valuation was inconsistent between the GST filings and the internal books, which meant two different numbers existed for essentially the same asset depending on which document you looked at. When the company approached a lender for a working capital facility, the lender's team requested 3 separate rounds of clarification on working capital because the numbers didn't hold together on first review. As a result, credit facility approval was delayed by 2 full months, a significant cost for a business that needed that capital to fund its operating cycle. After, a monthly receivables and payables aging MIS was introduced, giving the finance team a clear current view every month. Inventory was reconciled monthly against the GST returns, closing the gap between the two data sets. One clean working capital pack was prepared and shared with the lender, telling one consistent story. The facility was approved on the first review, and Bacha, this is the part I really want you to notice. Bacha, the working capital cycle itself got shorter because the discipline of tracking it monthly actually improved how the business managed collections and payments, not just how it reported them. Manufacturing as a sector sits in a tighter multiple band, 2 to 5 times, which means working capital discipline is often the single biggest lever available on both valuation and access to credit.